Hello everyone and welcome back to the channel. Today we are tackling a video that is a bit more technical than usual. We will be talking about derivatives and in particular about a formula that has made history in financial math. This one. I know it looks intimidating if you are not used to numbers, but don't worry, I won't focus on every symbol in the equation. That's for professionals. Instead, I will explain why this formula is so important in finance. We will cover 5 things: what the formula is for, what derivatives are, especially futures and options, the history of the formula, how it works, and what the terms mean. And last, some practical applications. So let's dive in after the intro. The Black-Scholes formula, derived from the Black-Scholes Merton model, has one simple but crucial purpose: to calculate the price of an option. In other words, how much should I pay today for the right to buy or sell a stock or a commodity at a certain price on a future date. The tricky part is that options don't come with a price tag. Their value depends on many factors: the price of the underlying asset, the time left to expiration, volatility, and much more. Sure, the value of other derivatives also depends on their underlying, but those can be calculated deterministically. Options are different. Their valuation must be done on a probabilistic basis. And that's exactly what Black-Scholes and Merton solved. Derivatives are financial contracts whose value derives from the price of something else. It could be a security, like a stock, an interest rate, a currency, or a commodity, like gold or oil. The two main types of derivatives are futures and options. There are much more, but in this video we will cover these two types. Futures. A future is a standardized contract traded on an exchange that obligates two parties to exchange an underlying asset, say a commodity, a stock, or an index, at a set date in the future and at a price agreed upon today. We have the long position agrees to buy the asset at expiration and the short position agrees to sell the asset at expiration. Meanwhile, gains and losses are settled daily through margin accounts, and in most cases there is no actual physical delivery of the asset. Calculating the fair price of the future is straightforward, using this formula. As you can see, is much simpler than the previous one. Just pay attention, then here E is the Euler number used for continuous compounding. That means interest is calculated as if it were credited at every instant, not just annually or monthly. For example, if today a stock is worth $100, the risk-free rate is 5%, expected dividends are 2%, and maturity is 1 year, then the theoretical price of the future will be about $103. And now the option. An option call gives you the right, but not the obligation, to buy a stock at a fixed price. A put gives you the right to sell it. The key word here is right, not obligation. You will exercise it only if it is in your favor. And that is the main difference with futures, which are binding obligations. There are two types of options: European options, exercisable only at expiration, and American options, exercisable at any time up to expiration. And again, two fundamental concepts. The strike price or exercise price is the fixed price stated in the contract. Meanwhile, the spot price is the market price of the underlying, which fluctuates constantly. The intrinsic value of an option comes from the comparison of these two prices. For example, if the stock is trading $110 and my call has a strike of 100, I have the right to buy at 100 something worth 110. That means the option is in the money, with an intrinsic value of 10. If instead the stock is worth 95 at expiration, the call is out of the money and its intrinsic value is 0. That because nobody would pay 100 for something worth 95. But intrinsic value only considers the strike versus the spot at one point in time. If there is still time before expiration, the spot price may move again. That's why time and volatility also matter. And that's where Black and Scholes and Merton come in. So we are in the early 70s of the past century. Until then, option markets were almost artisanal. Little transparency, prices set more by intuition than calculation. In 1973, Fisher Black and Minor Scholes published a paper that changed everything. Almost simultaneously, Robert Merton refined a standard model. The result? The Black, Scholes and Merton formula. Finance turned into quantitative science. The model was so revolutionary that Hewlett-Packard quickly launched the HP67 calculator, which could compute the Black and Scholes formula. In 1997, Scholes and Merton won the Nobel Prize in Economics. Unfortunately, Black, who had passed away, couldn't share it. The practical effect of the formula: the explosion of the derivatives market. With a common model, option become a global mass-traded product. Now, how it works. So, here is the formula again. There are two components. The first component is the present value of the underlying, and the second is present value of the strike price. Both are adjusted by probability factors from the normal distribution. Just a reminder of the meaning of the symbols. S is the current price of the underlying, the spot price. K is the strike price. R is the risk-free interest rate. And cap T is the time to expiration in years. And sigma is the volatility of the underlying. The two factors, ND1 and ND2, are cumulative normal distribution functions representing the adjusted probabilities of the asset ending above or below certain levels. In summary, the formula combines the present value of the underlying and the strike, the time to expiration, the volatility, and the probabilities. In elegant terms, it measures the value today of a right on a future event, balancing certainty, the present value, and uncertainty, the probabilities, and the volatility. And now, just a matter of curiosity. Can a derivative be worth 0? A future can only be worth 0 if the underlying itself is worth 0. An option can expire worthless if it is out of the money at expiration. A call when the spot price is less than the strike, a put when the spot is higher than the strike. But before expiration, even an apparently useless option has a positive price because of its time value. So there is always a chance the underlying will be moved in your favor. Some practical applications of this formula. First, pricing standard options. The formula gives a theoretical price for a European call or put option. Again, it helps determine whether an option is overpriced or underpriced compared to the model. For example, if a call is quoted at $5, but the Black and Scholes says 4.20, you may be paying too much. Again, for risk management, hedging. Dealers use it to calculate the Greeks, delta, gamma, vega, theta, rho. Example, delta tells you how many shares to buy or sell to hedge an option position. It's the basis for delta hedging, creating portfolios neutral to small price movements. For trading strategies, it's useful to build option combination knowing exactly what they cost given time and volatility. It also tells you how strong a move must be to justify the premium you are paying. Estimating implied volatility. Often traders use the formula in reverse. Take the market price of the option, input all other known variables, and solve for volatility. This gives the implied volatility, a key indicator of the market sentiment. Again, beyond financial options, applied in project finance and venture capital under the concept of real options. the right to expand, abandon, or delay a project. It's used in corporate valuation, the modern style, to price patents, licenses, and concessions that behave like options. So, in a conclusion, the Black-Scholes formula isn't just an elegant equation. It was a revolution in financial markets. For the first time, it allowed us to assign an objective price to uncertainty, combining time, risk, and probability. Sure, it has limits. Assumes that perfect markets without frictions, constant volatility, and ignores sudden shocks and fat tails. And yet, despite its simplifications, it remains the global benchmark for traders, banks, and academics. From a calculation tool, it has become a lens to read the market, understanding option value, estimating volatility, designing hedges, even valuing corporate decisions. In the end, behind the symbols lies one powerful idea: turning the uncertainty of the future into a number you can calculate today. See you in the next video.